Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I usually would dive in with Richard Clarida of PIMCO. He'd say, what's the market going to do? What's the Fed going to do? We're going to stop. And this is why we're talking to Richard Clarida today. Kacha Lakota of Rochester, when he was Federal Reserve Bank of Minnesota, said of the theories wrapped around Professor Clarida, modern macro models do not capture an intermediate messy reality that's out there. Right now, there's a messy reality
Very messy.
that we're all facing there. And to me, looking at the magnificent architecture of DSGE, folks, I'll say it once, dynamic stochastic general equilibrium theory, and the beauty of it, and not the physics envy, but just the wonderful thinking of it. You come here, and as Ned Phelps would say, go to the x-axis, short-term, medium-term, long-term. Yeah. You're in the Oval Office right now, and you got to explain to Trump and the gentleman from Pennsylvania, Hassett, the short term, the medium term, the long term of what they are doing right now. How do you explain that?
Well, what you say is the goal is to onshore, bring production back to the U.S., reduce the trade deficit. What we know is they can put on tariffs. They have the Liberation Day is tomorrow, but it will take several years for that production, if it eventually does ramp up, to boost the supply side of the economy. We have supply chains. Tariffs are essentially a tax on inputs to production, so that slows it down. Also, the uncertainty about what the policy will look like in the future as well. So right now, what you're getting is a lot of uncertainty. It's slowing the demand in the economy. Eventually, you may get more jobs and more production, but that's several years down the road. So right. I think I want the folks in the Oval Office to understand the time dimensions at work here, for sure.
Stephanie Kelton has a theory, which is very much against people like you, on what modern monetary theory should look like. And part of that theory is the intrusion of politics into monetary economics. Right now, we're doing almost Volrasian tariff law, McKinley tariff law, certainly, from the 19th century. Can the political system be patient enough to get to Clarida's medium-term success?
Well, I'm not sure. And in particular, it gets at another fundamental idea in economics, which is the idea of time consistency, that eventually people figure out that your promise now may not be delivered in the future. And so that's why, in particular, if the 20% tariffs that we're hearing about are really the beginning of a negotiation, that also adds an additional layer of uncertainty on top of just knowing what the tariff number is now. You know, Tom, we saw when I was at the Fed in 2019, that in fact, just the uncertainty about the trade policy itself was a damper to the economy. And that's a very tangible fact of life in macro. And I think we're seeing an elevated version of it now.
And Richard, I think we're seeing some, the folks on Wall Street start to take down their GDP numbers, maybe ratchet up their inflation expectations. Are they too early here, or is that a reasonable, I guess, near to intermediate term outlook?
Well, you know, Paul, everything in macro is a probability. And so I think it is appropriate to move up the probability of a recession. It would not be my base case now, but it's certainly somewhat more elevated than it was. In particular, I think the other piece of this, Tom, getting back to your point about the about the x-axis, is there's a lot of talk about fiscal. You know, no tax on tips, Social Security, tax deductions to buy a car. But again, that's going to take most of the rest of this year to work its way through Congress. And so again, there'll be uncertainty over that piece of it as well.
And given that backdrop of uncertainty, Richard, is there anything Fed policy can do to really, counteract or to impact the economy? Because it doesn't feel like there's much the Fed can do in the face of what could be a slowing economy and higher inflation.
Well, I think here we want to distinguish between what the Fed can do and what they will do. You know, what the Fed could do is cut rates preemptively. That's more or less what the Powell Fed did during my time there in 2019. The economy began to slow because of trade policy uncertainty. Inflation began to fall. And so we cut rates, essentially an insurance cut. I don't think the Fed really now has the runway to do an insurance cut. In other words, we may need to see a very tangible slowing in the economy, in the labor market, rise in the unemployment rate to get the Fed off of hold right here.
If you're just joining us across the nation, we're with Richard Clarida, the former vice chairman of the Fed. We have a spectacular set of conversations for you today. Nancy Lazar will be with us later, among others. Michael Nathanson. Paul had a tantrum yesterday and said, get Nathanson. We have Michael Nathanson here with a interesting essay on YouTube. We welcome all of you on YouTube. Subscribe to Bloomberg Podcast. It's our wonderful new distribution. Thank you for a successful March, Paul.
Richard, so, it's interesting. Some of the the data that the Fed looks at, historical data, still shows the economy's in pretty solid shape. But boy, I get kind of spooked. And I think the market gets a little spooked when they see survey data like the University of Michigan data showing that, boy, consumers really are concerned. Their sentiment is falling. Their inflation expectations are rising. How does the Fed look at that type of data?
It's an input into the projection. I think Chair Powell mentioned at the press conference last week that they look at the survey data, but the survey data doesn't necessarily translate into hard data. Eventually, I think what we have seen, even Paul, in the hard data is a pretty noteworthy slowing in consumption side of the economy relative to a really strong fourth quarter. I think a lot of reason why sell-side houses are marking down their forecast is not so much the survey data, it's the tangible data on consumption being very, very soft in Q1.
You more than anyone have got to go from the academics at DSGE and your work at literally building the modern Columbia program. Did you bring Woodford over? Were you the one that said, Michael, come on over?
I wish I could take credit for that. That was my successor, Don Davis, who brought Woodford over.
Very
but I
cool.
was leading the cheerleading effort to do it.
There was a cheerleading effort, and they used torpedo bats at the Columbia right now. So Richard,
but I did bring in Stiglitz.
Okay, you brought. Well, that's
take credit for that.
Okay, that's good. Yeah. But the thing here, Richard Clarida, is to bring this over to the application of what we're doing now. The theories to me are literally out the window. What is the theory of the dual mandate right now?
Well, right now the labor market's where the Fed wants it to be. We have about a 4% unemployment rate and all broad measures of the labor market. So the Fed wants to keep the labor market where it is right now. Chair Powell has said a number of times that the committee doesn't think that the labor market now is a source of inflation. So they're very happy with where the labor market is. What they were thinking 6 months ago is that they were on a glide path to this soft landing, although they didn't use that term. And I think the glide path has been delayed somewhat.
My 10-year real yield here, Jerome Schneider called me up from PIMCO, who got up early. He says, Tom, the 10-year real yield, 1.78%. It's coming down, down, down. If you're talking to PIMCO troops right now, are you modeling out a higher unemployment rate? I got Atlanta GDP grim. I got Federal Reserve Bank of New York disagreeing with that. Where is Richard Clarida on the vector of the unemployment rate?
I think the risk is to the upside. And indeed, if you look at the Fed's projections 2 weeks ago, where they show a chart that what is the risk to the unemployment outlook, it's to the upside. So I think there's some upside risk right here. At minimum, given what's going on with Doge right now, we're going to see some increase in unemployment through those efforts. Also important to note that even coming into the year, Tom, if you look at private employment, in particular, excluding healthcare and education, which have a pretty big government backstop, private employment had been really slowing throughout much of last year. So that I think that's also relevant.
How do you view the consumer here today, Richard? It just seems like anytime over the last 12, 15 years, you get concerned about the economy, but the consumer hangs in there and generally keeps spending pretty well. How do you think about the U.S. consumer?
Well, in the aggregate, there are 300 million consumers, and in the aggregate, they're in great shape. In particular, high levels of net worth. If you own a house, if you have money in the stock market, you've had a really good run for the last several years. But about a third of Americans don't own their own home or don't hold any stock. And for them, it's a very different outcome. So what you're starting to see in the data now is a pretty strong, if I may use the term, bifurcation between upper income consumers and consumers who don't own their own homes or have a lot of stock market wealth, and then they're getting pinched.
Okay,
right
this
now.
is the heart of the matter. I mean,
Yeah.
Alan Meltzer almost took a swing at me at Jackson Hole once over this, because Alan Meltzer wanted to go back to 47 and aggregate data. You've been teaching that for 25 years back when you were at Illinois. We're aggregating data. You just described a barbell, John Edwards, two Americas.
Oh, yeah.
Around the table at the Eccles building, besides arguing over who's got Redskins tickets, forget about that. But around the table at the Eccles building, are you looking at two Americas or some economic aggregated fiction?
Well, I'll punt and say you look at both, but certainly during my time there, the staff did very, very good work on looking at very disaggregated data. Forget, two Americas that were looked at like 38 different parts of the economy. So you do both.
Oh, come on. I mean, Jason Furman, in his wonderful New York op-ed, we'll get Professor Furman in up at a school in New England somewhere.
Yeah.
Jason says flat out, tariffs kill the poor and the tax cut goes to the rich. It's a single sentence in there. Surveillance correction, Lisa. Thank you for noting it. It's not the Washington Redskins. It's the Commanders.
That's
my
right.
folks' pie.
Oh, wow.
That's my excuse me.
Maybe we'll go back. Who knows?
Maybe I'll still have a job.
The world's changed. So, Richard, where do we go from here? What's the key thing that you're looking at here for this economy? Is it the tariffs? Is it the consumer? Is it the labor market? What's the key thing you're focusing on?
Look, I think the issue is we're in a period now where measured inflation is going to go up because of the pass-through of the tariffs, and activity is going to slow. So the real question for me, Paul, is are we going through what I call a whiff of stagflation, or are we really entering what would be a pretty persistent stagflationary crunch? I'm still relatively optimistic. I think it's more of a whiff than a new normal, but it's certainly something that would be quite relevant. Yeah.
It seems like a tough political call there to slow this economy and to rise inflation. Is the longer-term gain that this administration sees from perhaps reshoring more manufacturing, is that a realistic expectation, do you think?
Well, it is a realistic expectation, but it will not happen overnight. It will take several years. And in particular, in fairness, we saw a version of this in the Reagan administration. People think of Reagan as being a free trader, and he may have been philosophically, but the Reagan administration which I actually worked with back in my youth, was actually quite interventionist. In particular, they had a policy known as voluntary export restraints on Japanese cars. And what the big Japanese automakers, Toyota and Honda, realized is the only way for them to have a presence in the U.S. was to build a lot of factories in the U.S. And so
that worked.
An ambitious enough trade policy can lead over time to some onshoring, but it won't happen overnight.
I got 8 ways to go for a final question. I want to go to zero sum, but it's too early in the morning for a zero sum discussion here. The heart of the matter is a president is looking at this as a bilateral discussion. The giant William Klein at the Peterson Institute aggressively disagrees with that. What's our multilateral outcome of this bilateral naivete?
I think we'll learn a little bit more tomorrow about how much of this is intended to be permanent and how much is an opening, art of the deal negotiation. If it is, as I suspect it will be, the opening rounds of multiple negotiations across different countries, then it's certainly not going to be. It's certainly not going to really be a multilateral plan. It'll be a series of bilateral deals.
Is GATT gone? Pardon the phrase. Is GATT gone?
Yeah, and I think the evidence in favor of that is that the Biden administration really didn't try to resuscitate the WTO. So
why didn't they? Why didn't they resuscitate the Atlantic Charter off of Newfoundland in 1942 when we were flat on our back?
Well, you would have to ask them, but the political center of gravity in the last 4 years before Trump 2.0 was really not to engage in the WTO. We never staffed up the dispute settlement process.
That's completely fair. I mean, it goes back to Trans-Pacific failure.
Yeah, and very good reminder, the Trans-Pacific Partnership, exactly. Yep. Yeah.
You going to come in tomorrow for Liberation Day?
I'll do it by phone. How about that?
Richard Clarida, thank you so much. Generous of you to be with us.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The only one on Wall Street with a torpedo bat at home, first in line with Anthony Volpe's bat. Michael Nathanson joins us right now. Michael, I don't care about YouTube. Your wonderful essay with MoffettNathanson. All I want to know is a torpedo bat. Do we ban it and get back to traditional baseball?
Oh, Tom, it's the best thing for baseball. How can we ban it? This is a sport that needs something, right? It needs some excitement, some energy. I say give everyone a bat.
So
everyone
this
gets a bat.
This is like the Wilson. I think it was the A2000 with Jimmy Connors. As we got a metal tennis racket. Get used to it.
Oh, without a doubt. Baseball could not have made a better outcome for themselves right now, right? 1,000 home runs for the Yankees. It's a gift for the season.
It's like home run derby. Would you like to start the interview, Paul Sweeney?
Exactly. Hey, Mike, your note on YouTube hit my inbox yesterday. I read every word of it. I know it's been picked up by a lot of media. Can you frame out for us how big YouTube has become as a media company?
Okay, so there's a couple ways to look at it, and good morning, guys. One is simply by revenues. Believe it or not, it's $54 billion in revenues with advertising, the bulk of that, but there's a subscription business. So it's $54 billion. It's literally, with a rounding error of Disney, and by this year, they'll pass Disney in revenues, advertising subscription. In terms of time spent, I think you know this from where you guys have your show playing. If you look at connected TVs, more people watch YouTube than any other service.
Wow.
It's bigger than Netflix. It's bigger than Disney Plus. If you look more broadly at just content, linear content, channels, cable plus satellite plus streaming, they are still the biggest service of the TV glass, right? And they also position on your phone and your desktop, and they're also global. Right, so it's a monster of a company. Unfortunately, because of Google's, the focus at Google search and kind of the worries about search, people have ignored just the strength of YouTube. But we keep pointing out every year just the monster that it is, and it's going to overtake Disney by 2025.
Michael, I'm looking at the subscription revenue for YouTube, which has become a force. Am I to assume that most of that subscription revenue is folks that maybe cut the cord and said, but I find value in YouTube?
It's a bit of a blend. So I think Tom was saying before, half of it's YouTube Premium, which includes YouTube Music, and we'd say there's about 9 to 10 billion remains is YouTube TV, which I have. I think it's raised prices, unfortunately, but we think by 2026, the end of 2026, they'll be the biggest pay TV company in America. They will surpass Charter and Comcast. Right? They're adding 1 million subs a year, and everyone else is losing subs. So it's going to get to be a monster of a company on pay TV as well.
Michael, I want you to talk to Entertainment Global Wall Street that listens to us. We thank all of you around the world, and particularly in LA and New York, glued to Lucas Shaw and Screen Time and what we're doing here with Paul Sweeney's leadership on entertainment. I'm going to pick on CNN just because Mark Thompson had a wonderful interview, I think in the New York Times 9 months ago, I'm guessing, where every other paragraph ended with the basic thought, we don't know what to do with YouTube. What should traditional large media companies do with YouTube?
Yeah, Tom, you have no choice. YouTube is the platform, right? You have to do what you're doing. You have to basically use it for its fullest capabilities, right? So you have to basically program long form like you're doing. What's missing in media is short form, right? There's not enough attention on kind of the YouTube Shorts or TikTok, or Meta Reels. You have to come up with a way to leverage short form video, and also you have to become a creator. Like you have to basically become a Mr. Beast, which I don't know if you're familiar with.
Please.
And basically, you have to program for all types of consumption, right? So I think what everyone can do is do long form content. But what's missing here in the DNA of these companies is that short form creator economy where you're using the difference, kind of the short form, essence of YouTube to break through the clutter. It's hard because there's no barriers to entry, right? Like the great business that we've analyzed in our careers had a big moat. It was called cord cutting. It was a cord,
Okay, but this is, first of all, I was talking with Jimmy Donaldson the other day. I really told him he's killing it with Mr. Beast. I'm looking, Michael Nathanson, at the financial side of this. How does traditional media find, Paul, help me here, the fixed cost benefit of YouTube? I don't see it. How do they cover fixed costs on revenue or down the income statement to the Paul Sweeney's looking at this EBITDA thing? How do they do that on YouTube? I see no evidence.
Well, Tom, you have to basically create an alternative studio, right? You basically have to invest in startups, and it's not going to be in your P&L, right? It has to be, to your point, the infrastructure of the companies we cover is just too large to make money in YouTube, but it has to be a confederation of small startups that you invest in, right? You have to basically think of this as a portfolio that you're investing in off to the side that's going to grow one day. I don't think they have the DNA, to your point, and the financial structure to play small ball, right? This is a small ball kind of approach. You have to break yourself away and basically hire a bunch of young people to do it. It's got to be a fragmented view.
Hey, Mike, as always, your research note is full of lots of numbers, lots of great analysis. The one that jumps out at me, if YouTube was a standalone business, public comps suggest the business would be worth $470 to $550 billion, or about 30% of Alphabet's current valuation. I'm going to put on my investment banker hat here, Mike, and I'm going to go out there and say, let's spin this thing out. Let's IPO this thing. What's the company say about the structure of this company?
The problem is, Paul, it's that, all the infrastructure is built off of a common backbone, right? So all the data centers, all the investments in AI, the go-to-market sales strategy, there's just too much shared services for it to happen, right? It's maybe the government will, we don't know, policy seems to be fluctuating, but maybe the government will break them up. But for today's purposes, they've built it on the back of one infrastructure. It's too hard to do right now.
I mean, a guy named Moffett and a guy named Nathanson came out with, I'm going to give Rich Greenfield some love here as well, a massive upfront on cord cutting. How does cord cutting now fold into this migration to the only thing my family watches, YouTube and Netflix, like 95%? What's that dynamic look like in 2030?
Okay, so great question. We have about 67 million pay TV homes right now. We're losing about 5 million a year. So in 5 years' time, we'll be down to around 40 million pay TV homes. Those homes will be there for live sports and news, 40 million. But that leaves 90 to 100 million homes watching YouTube and Netflix, right? And the challenge would be for those 40 million homes that remain, why are we there? And we've talked about this for a long time, Tom. The glue is sports, but if sports keeps leaking into streaming, it's going to be harder for all of us to defend paying $100 a month for TV, right? So our view is then YouTube has the ability to become an aggregator where they basically take everyone's services and rebundle it into something called cable TV, but it's in streaming, right? So it's basically, as Moffett said 20 years ago, turns out that cable was a good business. It's going to take 20 years to realize that that's the right model, right?
But Paul, get one more question in here. I'm depressed. Out on YouTube live chat, Dorsey says Tom should start streaming 6 hours a day. I'm not joking.
Really?
Yeah.
Not working. That's not in your contract.
Is Dorsey Craig Moffett in disguise?
Exactly.
Get one more question in here with Nathanson.
Hey, Craig, that begs the question here. I mean, our good friends at Paramount, Warner Brothers Discovery, everybody else. I mean, if I don't have a theme park business, what am I doing in the media business these days? What do these companies do?
They have to consolidate, right? We've been waiting for this dance to come to an end. You have three services, Max, Paramount Plus, and Peacock, that somehow need to aggregate. And that's the last kind of the piece of the puzzle. But it's not clear, again, with this administration, how those companies can get bigger politically. So I think we're in this imperfect world where you have some people who've scaled. Tom mentions Netflix and YouTube. We put Disney there. The rest have to get bigger. And luckily, Comcast has a theme park they're building out that's going to get bigger, Epic. and Disney's got a theme park, but the others need to consolidate and take out capacity.
Right.
Wow.
Michael, one final question. Rich out on YouTube sends in this email, and I love it because we just spoke to Sebastian Page of Sherbrooke, Canada, as well. The Rangers have never been this bad. Is the kid from Boston College, Yannick Perreault's kid, Gabriel Perreault, is he the hope, the future of your New York Rangers?
Thank you for ruining my morning. I don't know because I mean, he's a good scorer. We'll see about his size. Can I just say something? I mean, we had a number 1 pick and a number 2 pick, right? That doesn't happen that often 2 years in a row. And it didn't work out very well for us. So I am in a sad state right now about the New York Rangers. I think it's regime change there. It really has to change.
I totally agree with you on size. I mean, Perreault's modeled out at 5'11", 165 pounds. Let's say he pops 30 pounds on weightlifting. Jeremy Rennick, I don't know if he could skate today. Yeah. The kid out of Thayer in Boston.
Yeah.
I mean, Roenick, excuse me. I mean, what? Rennick, it's like Wicked. The answer is I just don't know. The size, I'm with Michael Nathanson on this. I know. We need some big guys playing, well, the Rangers are gone. Michael, thank you so much. Congratulations. We still need to get you and Craig Moffett in the studio to do an entire hour State of Media because we get a huge response when you're on. Thank you for the wonderful comments out on YouTube. Greatly appreciate that. Michael Nathanson with MoffettNathanson.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us now, we are thrilled to bring you really a historic time for the nation. Nancy Lazar, definitive at C.J. Lawrence over the many years, now at Piper Sandler, and just a perfect time to speak to Nancy. Nancy Lazar, is any of what we're doing with tariffs, with a bilateral economic policy, is any of this in the textbooks you studied a few years back?
Well, it's in the textbooks, but it just has a negative connotation when they write about it in the textbooks. Free trade is definitely a healthier economic backdrop. Fair trade is also key. And I would hope to some extent this does lead to, if there is any potential string of positive from this tariff discussion, that we do start having freer trade around the world. Near term, that's obviously not happening. These are huge taxes on consumers. We actually import more capital goods than consumer goods. This is going to be a big hit on capital good companies trying to build stuff in the United States. So very counterproductive. Clearly risk-taking GDP into negative territory, at least for a quarter.
I can't say enough, folks, about what we're trying to do here geographically. Ed Maletti just with us from Milwaukee, was strong with Allspring Now. And if Nancy Lazar with us out of Piper, with all of their heritage of Minneapolis, Piper Sandler, of course, Sandler, the wonderful New York City banking expertise, and of course her work at Kalamazoo on the west coast of Michigan is as well. Nancy Lazar, take the Northwest, the traditional manufacturing heart of the Great Lakes area. Where are they going to be in 6 months?
Well, again, tariffs are going to be a tax on the economy. I'm afraid manufacturing activity is going to actually take a hit as we go into the second quarter. And this is really, really unfortunate. We've had a U.S. manufacturing renaissance theme for 15 years. It started with the private sector and has been, we've had onshoring, clear onshoring, new companies coming to the United States because it was just, the U.S. was generally viewed as a better place to do business. We have our own energy, then we got the tax cuts. China was increasingly a bad actor. Industrial policy under the last administration, you actually saw onshoring decline, and it declined in part because of increased regulations. And so, to be a little more balanced, we are going to see decreased regulations. They're already unfolding. And so we're hoping this is short-term economic pain with these tariffs. But then as we move back half of the year, we can actually see things start to improve.
This is the heart of the matter. We had the Vice Chairman, Richard Clarida, in earlier, and he went right to the x-axis. Tell us what Nancy Lazar's x-axis looks like. Short, medium, long-term, the effect of these tariffs and their reciprocity.
Yeah. So first, let me say Anna Letty is a good friend of mine. So thanks for having her on this morning. Second, and Richard is a terrific economist. Wish he was still at the Fed. Bottom line is near term, if we get 20% across the board tariffs, which is what the chit chat is today, who knows, that would be a tax on the U.S. economy to the tune of minus 2% GDP. And so we currently, our base case for 2Q would be plus 2% GDP. So this basically takes us down to stall speed. If there is retaliation, which there probably will be, you will probably have a negative second quarter, assuming they're put in place immediately. As we go through the year, what's going to happen is you're going to start to see the substitution effect, and you'll start to see the sting out of those price increases come down. And so as you move into the back half of the year, maybe later in the back half of the year, inflationary pressures, the tax pressures from these tariffs starts to fade, inflation starts to fade. Second, you hopefully do then by also have the extension of the tax cuts. Again, these are not new tax cuts as of now. It's a full extension of tax cuts that are already in place, and it becomes more clear we are getting deregulation. So then in the back half of the year, maybe by the fourth quarter, could be potentially the third quarter, you see GDP start to reaccelerate. And we could get pretty bullish on the economy as we end the year, something closer to 3%, assuming these tariffs don't result in a global negative massive trade war. Why could we get more positive? Again, onshoring is a very, very big positive for the United States. We have a lot of productivity in this economy. AI is just going to make productivity even stronger. Deregulation is going to be a huge, quote unquote, tax relief for middle-sized companies. They've been squeezed dramatically from the surge in regulation over the past 4 years. Small, medium-sized companies create 80% of the jobs in this country. And so at the end of the day, again, you can see short-term pain for sure. Let's hope something doesn't crack as a result of this pain, i.e. what weak links crack usually do get hit. But as you move through the year, you can see prospects for a stronger economy, again, assuming this thing doesn't really turn into a massive global trade war.
Nancy, what are you modeling out for? What are some of our big trade partners, how they might respond here? It sounds like Canada wants to take a tough stand here. We haven't heard too much out of Mexico. Europe, we're not sure. How do you model that out?
Yeah, that's very, very difficult to model out. I was just in Europe last week, and quite frankly, I was trying to think, what did I see that was American? No cars. So they can't put tariffs on cars. They already have high tariffs on cars. And so it's not clear what they're going to do. It probably will be targeted. I was just talking to my eco team about this. Probably will be targeted. They've already done motorcycles and some whiskey, and probably will continue to go down that path. But again, it's not clear how much of that stuff they actually buy from the United States. I think the bigger issues are what we're going to see out of some of China in particular.
Just on the Bloomberg here, folks, with Nancy Lazar, I should say a Piper Sandler with us right now. Nancy, in this wonderful, generous conversation with you this morning, I'm looking at economic research come in, and everybody's looking at charts that really show consumer slowdown, the granularity that you were so famous for over the years. Which is the Nancy Lazar chart right now that describes America? Which is a chart that jumps out at you at Piper Sandler?
So over the past 2 years, what we call public employment. Public employment would include the government, federal, state, and local, education, healthcare, and consultants, have generated 92% of jobs over the past 2 years. The public sector has really been crowding out the private sector. You see it with that job growth. Private sector job growth has been flat for the past 2 years. Why? Because wages have been bid up because of this strong demand from these government-oriented sectors of the economy. Again, federal government, state and local government, education, healthcare, and consultants. They've created over 90% of the jobs over the past 2 years. That's just one way to highlight that government spending, which is about 25% of GDP right now, which historically has happened only 2 times in the past, during COVID and during World War II, has been this giant sucking sound from the private sector, keeping inflationary pressures higher for longer, keeping interest rates higher than they otherwise would be, lowering productivity. And so our hope going forward is, and again, looking on the bright side, because there's a lot of dark clouds right now, looking on the bright side, if indeed we can see some success in chipping away at government spending, you have more resources for the private sector. Inflation really cools off. You get interest rates down for the right reason, not because of a extreme economic weakness, which may be unfolding right now. So that's really been my big concern about the U.S. economy, that we end up more like Europe, where you have these bigger governments, and you just don't have the strength of the private sector. So again, I'm looking at the glass half full longer term. With hopefully on the plus side, this administration can be successful in stopping this giant sucking sound of the government sector, and have more resources available for the private sector, because we have so much potential in the private sector. We're innovative. Onshoring has been a theme, creating goods producing jobs, and so I that to me is the single biggest headwind to the economy, and it's got to change.
Right. So what we're hearing from a lot of companies on the most recent conference calls, and presumably we'll hear them on the upcoming earnings conference calls, is this word uncertainty. And I think there's concern in the marketplace that, gee, that could impact their ability to hire, their ability to spend money, to invest in their businesses. How big of a concern is that for you, just the level of uncertainty out there?
Huge. And when you have a sustained period of high uncertainty, you definitely get the knock effects that you were just talking about. And so that, again, is a headwind to the economy right now. As we go through, we're probably going to see it in the small business confidence index data we're going to get next Tuesday, where small businesses are very uncertain. They've already pulled back on their CapEx plans. Based on the work one of my colleagues, Dave Wigglesworth, has done, the current increase in uncertainty does risk pulling GDP down to about 1.5 percentage point if it stays elevated. In particular, capital spending, obviously large ticket items, is most vulnerable. That could go down significantly if uncertainty stays high, to the tune of about 7% drop in capital spending. Big ticket item, you're going to postpone potentially putting that in place until you understand what's going on with tariffs. And so the combination of the tariffs and this high uncertainty is a huge risk to the second quarter. And I agree with your point on company earnings. The 1Q earnings season, we think, is going to be very, very uneasy, potentially negative. We already had United Airline highlight how even before the tariffs, you had this cutback in government travel. And at the end of the day, that they saw business down 50%. And so, yes, I think the 1Q earnings seasons could be very, very difficult.
Nancy, thank you so much. Nancy Lazar with us, just absolutely brilliant there on the combination, the sum of so-called government employment, schools, health, education, everything, and 92% growth at the margin. Just extraordinary perspective. Nancy Lazar with us with Piper Sandler.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Chris Ailman, former CIO. He was at CalSTRS. He's retired. He's like living.
He was there forever.
This is great. Chris joins us this morning. Chris, what's so great about your experience is, one little thing you do, you can't move the needle because you got so much money. Where do you find alpha right now in this maelstrom?
Tom, it's a huge challenge, and global CIOs are just they're befuddled because the world is, how should I say, instead of chaotic, it's so flexible right now. And so a lot of them are sticking close to their traditional asset allocation. Others are using total portfolio approach, but they're really having to think about risk differently than they did before.
And it's interesting, Chris, one of the phenomena that we've seen here in the first quarter of trading is the dramatic underperformance of the U.S. market versus the rest of the world, levels we haven't seen since the 80s, Bloomberg News is reporting. Is this a short-term trade, this underperformance, or is it something more, do you think?
Make Europe great again. No, I think that it's part of the shift to a more global and now more local economy. Like Tom knows, it's always the economy, Paul, and it's interest rates. And around the world, people were recognizing in the fourth quarter last year that the U.S. had suddenly become 2/3 of the global financial market, that's unusual. And we do revert to the norm over time. So we're starting to see that trade back. And I think people with a true global portfolio are happy. People that got concentrated in U.S. tech are unhappy.
Will Mag 7 come back? I mean, they got resilient. It appears they have above average revenue growth. It appears they have persistent free cash flow. Is this the opportunity, Chris, that you didn't have when they're trading at 70 times PE?
Well, they're still pretty rich, Tom, but you said it at the beginning. They've got free cash flow and they've got real earnings. That's the difference between, 01, 02 and the internet bubble and now. So these are real stocks. They do have long, but I think Wall Street, like always, overshot. It got overexcited about AI. We're starting to see uptake. It's slow. It has profound implications, but it's over a long time period. It's not just revenue now. So I think that people have to take a decision about how to buy those stocks. And do you buy all 7? I doubt it. You buy a few of them or you index. And you know me, I like indexing. So I just buy the whole market and trade with it.
Hey, Chris, I know you host a every other month call with some of these leading global CIOs. How do some of the non-U.S. money managers view what's happening here in the U.S. here? Do they see it as a buying opportunity, or are they kind of fretful here?
They're applauding. I talked to a lot of people up in Canada, in Australia, New Zealand, and in the EU, and they don't have a home country bias. They are truly global in their portfolio, but they're happy to finally see some diversification and some improvement because they have real assets often in their home country, and their currency is a big focus. So the weakness in the dollar that's forecast is a huge trade for them. And they see this as a bigger opportunity in their portfolios, finally to diversify away from the USA.
And what we do on Bloomberg Surveillance, folks, is to talk to somebody with a lot of experience about the marketing moment we're in. Paul, it's been at least a huge 2-year bull market, right?
Yep, and it's been driven large by the
So
tech.
what you do for scared people is you come up with derivative strategies like call writing, option, dividend enhancement, etc. It's run amok right now. Everybody's doing it. They did it with Bitcoin, money flowing in, money flowing out right now on Bitcoin. Chris Ailman, on the creative investments going on right now across Wall Street, including option writing and dividend enhancement. We've seen this before, haven't we?
Oh, yeah. No, Tom, people reach for yield, and the old phrase, pigs get slaughtered, lambs get sheared. So people that are worried, the institutional investors are very slow to uptake these new ideas. The one big common one is total portfolio theory, and it's just a different way to look at the world instead of traditional asset allocation. But they are not jumping into digital currencies. That's a hot debate for the 300 Club. They're not jumping into some of the derivative securities. They like good solid stuff like infrastructure. Paul and I used to talk about municipal bonds, my favorite area. Good, solid, steady income is still a sought-after thing for a big institutional portfolio.
Hey, Chris, in 2023 and 24, the real theme there driving markets higher was AI, as maybe epitomized by the Mag 7. Is this a market, or can the broader markets work if tech is not leading?
It can, Paul, because we have seen what should be a decent economic boost with lower interest rates. And some of the policy changes in theory, but it's been slow. And you guys are seeing it. It's going to be the manufacturing numbers are going to be probably pretty startling. I think the average consumer is pretty slow, and I'm seeing empty storefronts, and I think retail sales are moderate, but they're not running gangbusters. So, it always comes back. It's back to the economy, stupid. So. Take a look at that. The Fed has got to be frozen in here. I mean, it's so hard to figure out what to do, but I think the economy is slow, and so the market should be slow.
Thank you for unretiring. Chris Ailman, advisors. Chris Ailman with us this morning with all of his work for the California pension system.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Right now, important, what's in the newspapers, Mateo in at 1 a.m. trying to sort it out. What do you got?
First of all, people are asking, where's the bow tie? I want to just point that out in the live chat.
Yes.
Can you explain?
It ripped. For the first time ever, I put it on. Shoddy French material, and it ripped. And
A
I'll
wardrobe
get it repaired.
malfunction is what it's called in the media business.
Bow tie.
That's right. Bow tie malfunction.
They said, do you have a backup? And I'm like, no, that would make too much sense.
No, you need the backup.
All right, we're efforting that with the team here to get a backup.
Well, speaking of the live chat, YouTube, this is some interesting news about YouTube, about to surpass Disney as the biggest media company in the world. Now, this is according to MoffettNathanson analyst Michael Nathanson, who actually is going to join us in the 8 o'clock hour.
Yes.
Didn't even realize that. But YouTube, the second biggest media company in the world last year, brought in $54.2 billion 2024, and that was just $5.5 billion behind Disney. And he predicts 2025 YouTube should really eclipse them, become the biggest media company in the world.
What do you think, Paul?
Yeah, and it's only 20 years old, but it just goes to show that's where the audience is going. And when the audience goes, advertising revenue follows.
Correct.
And as Michael points out in his research note, which came out yesterday, and I read every word of it, subscription revenue too. So as people cut the cord, it's not that they're not willing to pay for content, it's just which content they want to pay for. And they're happy to pay for this YouTube content. So
and what's interesting too is that the audience they're saying went from the younger audience, and now it's growing beyond just kids. I mean, everyone is kind of on YouTube now.
If they get their fidelity straightened out, YouTube Music will win in 2 days. The search algorithm is so superior to the others, but they got to get the fidelity straightened out. It doesn't sound as good.
And again, we got Michael Nathanson, the author of that research note from MoffettNathanson, coming up in a few moments.
Not bad, not bad. Also, speaking of Disney, since we're on the same topic, Disney Snow White, we talked about it yesterday, right? Tanking at the box office. But like Paul said, it's no biggie, okay?
Why? Paul, discuss.
Yes.
Well, I mean, this is content that they're going to have all across their platforms, including some new stuff at the theme parks.
Yeah, but are we going to watch it? On streaming,
on the stream.
Lisa?
Yeah, digital copies, renting, video on demand. Then you have Disney, Hulu, ABC. Like, it's going to play across.
But if we don't watch it in the theater, why do we think we're going to watch it at home?
Because they say studies show that films that have controversy, which this one did have behind it, will take people out from the theaters, but they'll be more engaged to watch it streaming.
I do, but at the end of the day, they wanted to make maybe $1 billion global gross, and they're not going to get anywhere near it. So from there, it's a disappointment, and the people in the film division are getting their knuckles wrapped because this was a big miss.
So do they write it off so they don't pay as much tax on the money you're giving them at Disney World?
Now you get into film accounting, which is the most craziest accounting in the world. Just ask any A-list TV star or movie star who thinks they're owed a back end, and the studio says, "Oh, we didn't make any money. Wait a minute, you had $1 billion."
Lisa talks about it. I mean, Lisa's like screaming at Sparta, "Where's my back end? I was looking for my
exactly.
Next.
All right, last one. I'm pulling all, going all the way to the end. Canadians, they're drawing some inspiration from a hockey legend's rough style of play. I'm sure you're familiar with him, Tom. Canadian Gordie Howe, a.k.a. Mr. Hockey, right? Nice guy on the ice, but he was quick to throw his elbows up at opponents who contested him. So he got this nickname, Mr. Elbow. So the Wall Street Journal is saying Canadians are now turning to this elbows up movement. It's a rally against President Trump's tariffs, threats to make Canada the 51st state. So it's like another one of those.
I've seen that, yeah. Elbows up, okay.
It kind of took off. If you remember Mike Myers on Saturday Night Live, he did something on it, and that sparked it. You know, he pointed to his elbow, wore the shirt that said Canada's not for sale. He's from Canada. And so that sparked it. But then at the same time, you have Wayne Gretzky, who's getting the cold shoulder because he supports President Trump.
Yeah, Doug Ford, though, of Toronto came out, I believe, yesterday. I'm not sure quite the day. The leader of Ontario defended Wayne Gretzky. He said enough. He said he was, misquoted, whatever. I don't know the details as well. Right. Elbows up. Is it is Carney and the other politicians, are they heading for a minor? A major minor? A misconduct? Who knows? Lisa Mateo, thank you so much. The newspapers.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.